All the headlines are telling you that now is a terrible time to buy a house because of the high interest rates, but they're wrong, and I'm going to show you why. The problem is that what makes good headlines doesn't make good real estate advice. And if you listen to what the news is telling you, it may have you sitting on the sidelines watching your friends take advantage of the primary wealth building vehicle for Americans while you try to figure out how to get your new dining room table up the 3 flights of stairs to your apartment. Even worse than that, what the media is telling you is likely to keep you on the sidelines for a very long time, if not permanently. I'm going to tell you why the headlines are wrong and why now might be the very best time for you to buy a house, but it isn't going to be the best time for everyone to buy a house. So I'm also going to go over 3 simple criteria to help you determine whether you're the type of buyer who should buy in 2024 or not. Because let's face it, getting a purchase of this magnitude wrong can be the difference between ramen noodles and DVDs or Netflix and Thai food for your next Friday night. Stick with me to the end, and I'm also going to go over 3 easy and immediate action steps you can take right now to save you time and money on your home purchase and also make the process safer and more fun. For those of you that have been watching a while, welcome back. And for those of you that are new, you're probably wondering who I am and why you should listen to me. That's a fair question. My name is Rich Curtis with eXp Realty, and I've been selling homes up here in El Dorado and Sacramento counties for nearly 2 decades in markets ranging from the Great Recession all the way to the COVID market insanity and everything in between. So let's get stuck right into why this market might be the very best time for you to buy a home. Look, with everything that's going on right now, home prices being at an all-time high, interest rates being at an all-time high, I get the question from people all the time, Rich, why should I buy a house right now? And it's a totally fair question. In order to answer that, let's go over the 3 primary benefits of homeownership, and I'll let you know how interest rates affect each of those benefits so you can decide for yourself, is now a good time for you to buy or not? If you've been watching for a while, you've probably heard me say it before. The reason I'm so passionate about what I do is because home ownership built the middle class. It's the primary wealth building vehicle for most Americans, and it's often the first rung on the ladder out of poverty for American families. So it cannot be overstated how important home ownership is to your wealth and how much it will change your life. The primary reason for this is it fixes in place the largest line item in your monthly budget, your housing costs. If you continue to rent, then as your income increases, your rent continues to increase too. And you're in this constant battle between what's rising faster, your income or your rent. And it prevents you from putting into place key wealth building strategies like paying off debt, saving, and investing. When you purchase a home with a 30-year fixed mortgage, your housing costs are fixed permanently. You know month to month what you're going to spend every time on housing. Now your homeowner's insurance and your taxes can go up a little, but the bulk of your payment, which is your principal and interest, stay the same forever. This means that as your income rises, your housing cost stays the same, and you can use the difference between the two, the additional income that you have, for those 3 key wealth building activities: paying off consumer debt, saving, and investing, or just for some fun things like travel. So do the high interest rates have an effect on this first benefit of homeownership? Yes, they do, but not as much as you'd think. First off, regardless of the fact that these rates are higher than they were during the artificially low interest rate environment of the pandemic, you're still going to be locking in your housing costs as of today, and it can't rise moving forward. The only way that the interest rates really do affect this benefit of homeownership is that the lower the interest rate, the lower your payment, so the more money you'll have to put towards other things in your life. And of course, the opposite is true. The higher the interest rate, the higher the payment, the less money you'll have to put towards those other things. So how much difference are we actually talking about here in dollars and cents? Well, right now, the interest rates are bouncing around between 6.5% and 7.5%. And the Fed has just signaled that they don't intend to drop rates this quarter, and most likely they don't intend to drop rates next quarter either. They are still signaling that they intend some rate drops later this year, but they haven't committed to how many and what they'll be. There are lots of organizations that do predictions for mortgage interest rates, and there's a lot of variation here usually, but right now they all agree that the interest rates this year are going to stay between 6% and 7.5%, with the most optimistic predictions having it at about 6.1% by the end of 2024. Now, they're not predicting the chance of getting even as low as 5.5% until the end of 2025, nearly 2 years from now. And they've said it's very unlikely that we will ever see the artificially low 2.5% to 3.5% interest rate environment that we had during the pandemic. In fact, they've said it's reasonable to expect that 5% will be about the lowest we'll see, and we probably won't see that until at least 2026. So let's look at how much it costs you monthly at the higher interest rates and what the cost of waiting for those rates will be so you can make an informed decision. Here in Placerville, the median home price is about $500,000, and in the greater Sacramento area, it's a little higher at about $600K. Now, when you're looking to move to a place and trying to determine affordability, I actually think focusing on the average home price is a better way to go, but they base the appreciation predictions on median home price, so that's what we're going to use for our calculations. Appreciation just means price growth. Before showing you the estimated payments, it's important to note that we're only going to be talking about about principal and interest. We're not taking into account taxes and insurance. So the prices I'm quoting here are not the prices you would actually pay to purchase a home at that price. But since taxes and insurance are unaffected by interest rate and they vary by county and area, I'm going to leave them out so you can more easily see the difference here. But it is important whenever you're getting quoted a payment to get quoted a full PITI, principal, interest, taxes, and insurance payment to really determine if your home of choice is affordable for you. Okay, with that disclaimer out of the way, I'm about to drop a lot of math on you, but it's important because it's going to help you really determine whether now is the right time for you to buy or whether it's better to wait. So as we go along, I'll get the numbers on the screen for you. Feel free to pause anytime and take in those numbers. Look, if at the end of these numbers and the end of this video, you still aren't sure if you should buy now or wait for interest rates to come down, feel free to reach out to me via the contact information on your screen or in the description down below. I've helped hundreds of families just like yours over the years make high quality real estate decisions, and I'm always happy to help. All right, now on with the numbers. So to buy a home at the median home price of $500,000 with 20% down on a 30-year fixed rate mortgage, you're going to be financing $400,000. And today's interest rate, as of the recording of this video, is 7.25%. Like I said, we've got a lot of numbers coming your way, so you're gonna have to excuse me an occasional glance at my notes. So if you finance a $400,000 loan at 7.25%, your principal and interest payment will be $2,728.21. At 6.5% interest, that same payment would be $2,528.27. Again, follow those numbers along on your screen. And if rates follow the most optimistic prediction and get down to 6.1% by the end of the year, your principal and interest payment on that $400,000 loan would be $2,423.98. So the difference between getting a $400,000 loan at 7.25% and 6.1% for your monthly payment is $304.23. Now, I'm not dismissing that. That's real money and can make a real difference in someone's monthly budget. But during that same period, from the beginning of 2024 to the end of 2024, the median home price in California is due to appreciate or go up in price by 6.2%. That means by the time the rates get down to 6.1%, that home that you were buying at $500,000 will now cost you $531,000 with a principal and interest payment at 6.1% of $2,574.27. So when accounting for the increase in home prices, waiting till the end of this year to buy a home so that the interest rates come down for you will only save you $153.94 a month on your monthly mortgage payment. But that doesn't really tell the whole tale. Because your purchase price went up and your taxes are based on that purchase price, your taxes went up as well. In fact, they went up by $25.83 per month, bringing your actual savings down to $128.11 a month. Because the purchase price went up, you also had to put down an additional $6,200 as a down payment. Your taxes are fixed at that point forever. They can only go up from there. There's no way to effectively adjust them down versus interest rate, which if the interest rates come down and you still qualify for a loan, you can refinance down to those rates in the future. Now also over that time, you've lost the opportunity to get the 6.2% appreciation, which in this case amounts to $31,000 in equity you didn't get. So to recap, if the best case interest rate predictions come true of hitting 6.1% by the end of the year, you will have had to pay $31,000 extra for that home and lost out on gaining that $31,000 in equity for yourselves for a net loss of $62,000. You also have the additional $6,000 you have to pay in down payment for a total loss of $72,000 in order to save yourself $128 a month. Look, this kind of nuanced analysis doesn't make for good headlines or good clickbait, but it certainly makes you better informed and wealthier, and that's what I'm here for. Waiting to purchase a home based on interest rates in a market where home prices are going up amounts to stepping over dollars to pick up pennies. But thinking it through this way gives you a valuable bonus way to assess whether you're the type of buyer who should be buying in 2024 or not. If $128 a month is a make or break point in your budget for buying a home or not, then my advice to you is that you simply aren't ready. You shouldn't move forward with a home purchase if your budget is resting on that thin of a margin. But that's okay. Everybody has to start somewhere, and now you know you just have to spend a little bit more time preparing for your home purchase. And you can take advantage of my #1 secret way to get ready to buy a home, which I'll share with you later on in this video. Now, I bet you're thinking, what if I wait until the end of 2025 to get that 5.5% interest rate? Well, not to bury the lead here, it gets worse, but let's run the numbers and find out. In order to do that, we have to pick an appreciation prediction for 2025, and that's a little harder to do because it's a little farther out. But according to Lawrence Yun, the chief economist for the National Association of Realtors, homes in the entire country are going to appreciate between 15 and 25% over the next 5 years. This is another reason why getting into the housing market as soon as possible is so important. So let's take the low end of the predictions at 15%. That works out to be 3% a year, which is actually a good number to work with because the historic average is 3 to 4% appreciation per year. Now, to be clear, I actually think we're going to see more than 3% appreciation in 2025, but it's always good to work with the most conservative numbers you can. It's also important to note here that there's no guarantee that your home will appreciate at all, and these are all predictions, not guarantees. So if by the end of 2025, the mortgage interest rates do get down to 5.5%, you will still have experienced the 6.2% appreciation in 2024 and the 3% in 2025. So the home that you would have paid $500,000 for will actually cost you $546,930. That means you will have lost out on the $46,930 in appreciation in equity for yourself, and you will have to pay that additional $46,930 in order to purchase the home. Bunch of numbers coming at you. I'm going to go back to the notes here. So you will have also paid an additional $9,386 in your down payment and at a PITI monthly payment of $2,484.33. Your total monthly savings after accounting for the taxes will be $204.78 per month. Simply put, in order to wait till the end of 2025 to get that 5.5% interest rate, if it really happens, you will have had to pay an extra $47,000 for the home, and you will have missed out on that $47,000 in equity appreciation for yourself. And you'll have also had the additional $9,000 in down payment that you've had to pay for a total loss of $103,000 in order to save yourself $204 a month. To put that into perspective, the 24 months of paying that additional $204 per month will amount to a total of $4,914.72. Whew, that was a lot of math, and I hope you're able to follow along with it on your screen. But I really wanted to give you the actual numbers. And as you can see, the results are pretty clear. The costs associated with waiting for interest rates to come down are far, far higher than the costs associated with having the higher interest rates on your loan. So essentially, that first benefit of homeownership is unaffected by the high interest rate environment we find ourselves in, which brings us to our second benefit of homeownership, which is building wealth through your home appreciating in value. The reason homeownership is a primary wealth building vehicle for most Americans is that in general, home values tend to go up over time. Of course, there's no guarantee that they will go up, and there are some short-term fluctuations, which we'll talk about later in this video. But in general, over the long-term time horizon, home values tend to rise. As I said earlier, Lawrence Yun, the chief economist for the National Association of Realtors, expects home values to rise in the country between 15 and 25% over the next 5 years. I think you saw in our example earlier that the later you get in, the more appreciation you lose out on. So getting into the market earlier has a far greater effect on your wealth than the interest rate that you get in at. To get a sense of just how much, let's look at the low end of that prediction, 15%. If that comes true, and again, it's just a prediction, but if it does come true, that house you bought today at $500,000 will be worth $575,000 5 years from now. That's $75,000 in equity gained for you in just 5 years. And that's just the first 5 years. So no matter how you run the numbers, staying out of the real estate market will cost you more than getting in at today's interest rates. And remember, if at any point after you purchase the interest rates do come down, you can take advantage of those rates by doing a refinance with some important caveats, which I'll go over in the next section when I cover the 3 simple criteria to determine whether you're the right kind of buyer to take advantage of the opportunities in this market or not. Even accounting for the higher interest rates, the second benefit of homeownership, building wealth through appreciating value, is still a benefit to you. The final major benefit of homeownership is that while you're fixing in place the biggest line item in your monthly budget, and while you're building wealth through appreciating home value, you also get to live in it and have a permanent hub of life for you and your family. You don't have to move ever again or worry about rents going up or your landlord kicking you out because they want to sell the place. You have stability, a home, and a hedge against your cost of living going up. And you have an appreciating asset that will support your family's future goals, be it paying for college education or retirement. In short, the three key benefits of homeownership are largely unaffected by interest rate, and the ones that are affected by the interest rate still have you coming out ahead even at today's rates. And the sooner you get in, the sooner those benefits compound for you. So 2024 is a great time to buy a house because you can begin to get the benefits of homeownership right away. And this is a very different market from the COVID market. The low inventory, high demand COVID market with all of its craziness is gone, and it's given way to a low inventory but low demand market that is much friendlier and easier to navigate for buyers. The highly competitive, price escalating, multiple offer COVID market environment is gone. You can be calmer, you can have a normal transaction length, you can preserve all of your contingencies, and you can feel far less pressure to make quick decisions, which will make your results much, much better. Once interest rates come down, we will be back in a high demand, low inventory market. The only thing really keeping buyers on the fence and keeping demand low right now are the high interest rates. Once those come down, all the buyers will jump off the fence all at once, and the multiple offer waiving contingencies, COVID market style insanity will return. This is why 2024 might just be the best time for you to buy a home. You can take advantage of this calmer, lower competition market, start getting all the benefits of home ownership right away, and if the interest rates come down in the future, you can always refinance and lower your rates. But this advice isn't good for everybody. In order to determine whether you should take this advice and jump into the 2024 real estate market, you need to make sure that you meet the following three criteria. Hey, if you've made it this far and you're getting anything at all out of this video, hit the like button, click subscribe, and hit the bell so you don't miss a future video with crucial information to help you with your home purchase. Now, of course, the risk with any predictions are, what if they're wrong? What if a new war breaks out? What if the economy craters? What if the real estate market goes down instead of up? How do I protect myself against those things? And the truth is, you can't. Those things are out of your control, wildly out of your control. But you can still make sound financial decisions by focusing on what you can control, your personal finances, and following these three criteria. The first of which is, can you afford this interest rate and thus this payment and home if interest rates don't come down soon enough or at all? You have to be able to afford this payment and this home no matter what. Now, of course, buying a house always feels like a financial stretch, and it almost always requires a tightening of the belt and removing a few things from your monthly budget. But because your income tends to rise steadily over time, this is a problem that rectifies itself. So that's not what I'm talking about here. I'm saying that if making this payment at this interest rate represents a significant financial hardship for your family and puts you on the ragged edge of affordability and puts strain on your monthly budget, then you should not be considering buying a home in 2024 in the hopes that interest rates will come down in the future and save you. On the other hand, if you can afford this payment at this interest rate with no problem, even if they don't come down, then you are the type of buyer who should get into the market as soon as possible, because you'll get all of the benefits of homeownership, and if rates come down and you can refinance, then things get better for you. And if they don't, you can still make the payment and you still get all of the benefits. The second crucial criteria to determine whether you're the type of buyer who should buy in 2024 or not is, do you have stable, recession-proof employment? You can't make a mortgage payment if you're unemployed or even underemployed. We're not out of the woods yet, and the threat of a full-blown recession is still looming. And let's face it, some industries weather a recession better than others. If you're a healthcare worker or a bus driver, you're probably going to be fine. On the other hand, if you sell high-end luxury items, these are the types of things that people forego when things get tight, and things might get a little rockier for you should we fall into a full-blown recession. So do a little self-assessment here about the stability of your employment. The final criteria to decide whether you should buy a home in 2024 or not is, do you plan on owning this home for 5 years or more? See, when you're purchasing real estate, the two things that determine how well you're going to do is how much you pay for it and how long you plan on keeping it. You can never go back and change the price you paid for it, so getting the best deal you can given the market circumstances you find yourself in is always crucial. But let's talk timeline here, because that one is far more important in the market we find ourselves in now. If you're purchasing the home now and you plan on selling it in less than 5 years, then in my opinion, you're the type of buyer who should consider not buying in 2024. With interest rates being higher and purchase prices being higher, you need a little bit more time for your investment to increase through appreciation to offset the higher cost and the higher interest rates. In today's market climate, in my opinion, less than 5 years is a risky proposition. Now, of course, look, we can never predict the future. Things happen, people get sick, people get relocated, you have an ailing family member in another state and you have to move. But right now, in your current life plan, to the best of your knowledge, do you plan to own this home for at least 5 years? 7 to 10 years would be better, but 5 years is minimum. If the answer is yes, then you're the type of buyer who should consider jumping right into the market and purchasing a home in 2024. On the other hand, if you're just finishing up school and you know you're going to move in 2 to 3 years, or you know your job's going to get relocated soon, or you do have those aging family members in another state and you think you might have to move to be with them in less than 5 years, then you should really pause and consider whether now's the right time for you to jump into the market or not. Right now, at least one of you is yelling at your iPhone or the TV, but Rich, I'll just refinance to a lower rate in the near future so I don't have to meet these 3 criteria. It's really not that important. And to that, I would say I respectfully disagree. A lot of you may have heard people in my industry use this snappy little aphorism, marry the house, date the rate. That is gross, salesy language, and I hate it, but it does make a reasonable point, the one that one of you is yelling at the TV right now, which is that you can buy at today's rate and then refinance in the future when or if rates come down. But there's one important thing that none of them ever tell you when they're giving this advice. There is simply zero guarantee that you will still qualify for a loan when the rates come down and it's time to refinance. That's a big problem. In order to refinance, you still have to qualify for the loan, and there's no guarantee that you will. So what are some things that could happen between now and then that would make you not qualify? Well, the list is long. You could lose your job. You could have your hours cut, so you have less income. You could end up divorced, and so you've lost your spouse's income. You could go out and buy a boat, truck, or RV, and so your debt to income ratio is higher. You could have medical problems and end up saddled with large medical debt. Your credit score could go down because you missed some payments or defaulted on a loan. You could end up having to have child support and alimony, so you no longer have enough income to qualify. Or the real estate market could go down instead of up. The list of things that could happen that change your financial situation and make you unable to qualify for a loan at the time you need to refinance is nearly endless. And if that happens, you're going to be stuck at the higher interest rate and the higher payment for the foreseeable future. For those reasons, it's crucial that before you decide to purchase right now at these interest rates, you determine, 1, whether you can pay that payment at today's interest rates no matter what for the foreseeable future. 2, whether to the best of your knowledge you have stable employment. And 3, whether you're going to keep that home for 5 years or more. So if you meet those 3 criteria, now is an excellent time to consider buying a home. But what if you don't? Well, that's okay. That just means you have a little bit of work to do. And look, 80% of the buyers I sit with in an initial buyer's consultation aren't ready to buy at that moment. They have a little more work to do. In fact, most of them have 6 to 8 months worth of more work to do, and that's okay. But by meeting with me, I can give them the action steps they need to get on the path to home ownership. So if you'd like to do a free, no commitment buyer's consultation with me, feel free to reach out to me via the contact information on your screen or the Let's Chat link in the description down below. I have people reaching out to me all the time for help like this, and in just one quick appointment, I can get you on the path to home ownership. So if you aren't there yet, then there are 3 action steps you can take right now to get you on the path. And number 3 is my secret best way to speed up your path to home ownership, so stick around for that one. Number 1 is to contact a local lender. Now, I know it seems a little awkward to contact a lender when you know you're probably not ready to buy yet, but a lender can get you on the right path, get your credit right, get your savings goals right, and put you in a position to qualify for the best possible loan, which is the number 1 way to save yourself money on your home purchase. It's important to work with a reputable lender that's familiar with the area you're looking to purchase in. So if you're having any trouble with that, feel free to reach out to me via the contact information on your screen or in the description down below, and I can connect you with some great local lenders that I've been working with for the last 2 decades. The number 2 thing you can do that's crucial in getting yourself ready to buy a home is to put the plan the lender gave you into action. You got to work the plan. I can't tell you the number of times that I've sat with a buyer in a buyer's consultation, connected them with the lender's given them an action plan, and when we check in 6 months later, they still aren't in a position to purchase their dream home because they didn't put into place the action steps the lender gave them. You have to work the plan. Now, number 3, and my all-time favorite way to prepare for buying a home because it will massively speed up the time between now and when you can actually purchase, is to pay yourself a mortgage now. Now, I know that sounds a little silly, but by doing this, you will increase your savings and you'll get a trial run as to what your budget will feel like if you do purchase a home. So how do you do this? Well, first you need to know what your mortgage payment will be. So you can use an online mortgage calculator, or if you have any trouble with that, like I said before, reach out to me via the contact information on the screen or in the description down below, and I can connect you with a local lender who can give you an accurate payment estimate to work with. But all you have to do in that online mortgage calculator is to put in the amount of the home you'd like to buy, the amount of your down payment, an estimate for interest rate, which, as I said, as of today, you could use 7.25%, and with a couple other variables, it will spit out a mortgage payment estimate for you. So for those other variables, make sure you're using at least 1% for taxes, although 1.25% would be a little bit of a better estimate, and make sure you're using a high enough number for your homeowner's insurance, because homeowner's insurance can be high here in the foothills. If you're having trouble figuring out what numbers to use there, feel free to reach out to me and I can give you some numbers to work with for a good ballpark. Once you have that payment estimate, simply subtract what you're paying for rent now from that mortgage payment and pay yourself the difference every month. Do this by setting up an automatic bank transfer on your payday for that amount to go from your checkings to your savings and see how it goes. This has two major benefits. The first of which is you get to see how tight your budget would actually be if you were making this mortgage payment. And the second is you'll be saving all that money every month. This will give you more money to use for down payment and closing costs, which will ultimately lower the cost of buying a home. It's a win-win, and it is the single quickest way to get yourself prepared to buy a home. All right, that wraps up our discussion of whether you should buy a home in 2024 or wait for the interest rates to come down. I know that was a lot of information, and if you've made it this far, you should feel proud of the investment you've made in your own financial education. And I really appreciate you sticking with us till the end. But none of this information will really help you if you don't know where you want to move. So to help you with that, you can click on this playlist right here on the pros and cons of some of our foothills communities. And if you're trying to decide if El Dorado County is right for you, click this video right here on 12 things you should know before moving to El Dorado County. And as always, thanks for watching, and I'll see you on the next one.